Vanguard's got two very good dividend-paying ETFs, and recently I've been asked multiple times which one is better. So in this video, we're going to take a look at these two ETFs, their different approaches, and then compare their performance. The two we're talking about is VYM, which is Vanguard's high dividend yield ETF. Its current share price is about $155. And VIG, Vanguard's dividend appreciation ETF. Current share price of about $277. Now, let's get into the data, but I do hope you hit the like button and leave me some comments below. I'd really appreciate it. So thank you. All right. First of all, they do take a different approach. VYM seeks to track the performance of the FTSE High Dividend Yield Index. The FTSE Russell is a subsidiary of the London Stock Exchange Group. This ETF is passively managed, so fees are going to be incredibly low. It's been around a long time. Its inception date was all the way back to November of 2006, and it has $175 billion under management or invested in it. Okay? VIG seeks to track the performance of the S&P 500 US Dividend Growers Index. It switched to this index back in 2021. Before that, it tracked the NASDAQ US Dividend Achievers Index. Now, the S&P 500 US Dividend Growers Index is created and maintained by the S&P Dow Jones Indices. This is also passively managed, so expenses are incredibly low. It's also been around since 2006, and it has $287 billion under management. Now, this one here only chooses companies that have increased its dividends every year for at least 10 years, and it also excludes the top 25 highest yielding eligible companies from the index. So in other words, of the companies that qualified to be in here, they take the top 25 highest paying dividend ones and exclude those, because those typically are not increasing their dividends maybe enough, or sometimes a high dividend is due to a falling stock price. So they just get rid of that. They're really focused on companies that are increasing their dividends every single year. So not always focused on the highest paying dividend companies. Companies that are consistently increasing their dividends typically have better share appreciation. Their share price goes up faster, so it can make up the difference there. Now, let's look at the top 10 holdings and sector weightings for each one. VYM has 560 companies in it. The top company, or in other words, almost 7% of the investment goes into Broadcom. Then we see JP Morgan Chase, ExxonMobil, Johnson & Johnson, Walmart, and so forth. Notice here, by sector, the biggest sector weighting, almost 21% goes into financial services. And then we see technology at about 16%, healthcare, industrials, and so forth. Now, this is a little bit different than VIG. It has 338 companies in it. You can see its number one sector by weighting is technology, so you're a little bit more exposed to technology here. That can be a good thing. It depends on what the market is doing. And then financial services, healthcare, industrials, and so forth. Broadcom is the biggest investment, taking in 6.24% of the investment. And then we see Apple, Microsoft, Eli Lilly. So you can see a difference here in the top 10 holdings. Now, what you're probably really interested in is the comparison of performance. First of all, VYM concentrates more on high dividend paying companies. So its dividend that it pays, 2.33%, is a little higher than VIG, which is only 1.59%. Remember, it excluded even the top 25% of dividend payers. It's focused more on companies that are increasing their dividend every year. So it makes up for it in share price appreciation. Expense ratios are very low for both. On a $10,000 investment, it would cost you $4 in fees per year. The beta score, what this means is a beta score of 1 means that you can expect that ETF to be as volatile as the overall market, usually represented by the S&P 500. A beta score below 1 means it's less volatile. So when we look at a beta score of 0.78, it means in general, it's about 22% less volatile than the overall broad market or the S&P 500. VIG would be about roughly 17% less volatile. So less swings, both up and down. The 1-year total return. VYM actually beats VIG by quite a bit here, but that's a 1-year return. Investors shouldn't really worry or care too much about what an investment does over 1 or 2 years. Notice here, if we take a 3-year total return, they're almost identical. A 5-year total return, VYM is a little bit ahead of VIG. But a 10-year total return, it goes the other way. So it would be very difficult to compare these two. Now, these rates of return are the total returns. That means it includes the dividend. So even though this one is paying a little bit higher dividend, this one is making up for it in share price appreciation. The share price is going up a little faster. Now, in 2022, it's a good year to look at because the S&P 500 dropped 18% that year. And even bond funds, the total bond fund, BND or AGG, okay, they both dropped more than 13%. So bond funds are not always safe. But notice here, VYM was essentially almost flat. And VIG did drop 9.79%, but still that's less than bonds dropped that year. So you can see they held up pretty well in a really bad year. Now, if we go all the way back to inception, when these two ETFs first started out, remember that was 2006. So this is going to include the housing crisis, which started in October of 2007 and didn't end until March of 2009. That was a very difficult time for the stock market. So notice that's going to knock down the overall average returns for a while. So the average return of VYM over that entire time since 2006 is 9.32%. VIG is 10.10%. If you want a comparison of what the S&P 500 did over that period of time, okay, from January 1st of 06, it averaged 11%, 11.01, and from January 1st of 07, it has averaged 10.76%, and that is up through currently. Okay, so there's a look at performance. Remember, notice it would be very difficult really to pick the best one here. This one's going to pay a little bit more dividend. This one, VIG, makes up for it in a little bit better share appreciation. So they're both very, very comparable, very good funds. This one actually has more money invested in it. And let me know in the comments which one of these two you would choose or which one you like. So thank you for watching. Please hit the like button, and I will see you next time.